And, a lot of the things that people had been talking about before, like motor vehicle insurance, as an example, that's going in the right direction, which that was a huge sort of issue over the last number of months up until recently. So the 3-month pace has basically ground to a halt in motor vehicle insurance CPI. Now, obviously, the PCE number looks at it a little bit differently, but I think non-housing services slowed, and that was a function largely of lodging away from home, so things like hotels, and less push from things like medical care inflation and auto insurance. And so basically, I think that's kind of what got the market going. And, considering the number came in better than expected, even though rental inflation ticked up a little bit, we know that the overall trend for that is still lower. So it just stands to reason that, if this number came in better than expected, despite rents going the other way, what's going to happen when rents kind of resume their downward trajectory, as I think is rightly anticipated. So I think that's kind of what the markets are keying off of. So it was a good number. And, this would be another month where, core inflation is running, somewhat below, on the PCE basis, below the Fed's target of 2%.
Welcome to RenMac Off Script. We're able to discuss markets, economics, policy, history, and life. It is Wednesday, the 15th of January, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account. We're hitting this early because Steve and I are at an offsite, and we'll be posting this Thursday morning, but thought at least the inflation data and some of these confirmation hearings were relevant enough that we would push this through. So, Neil, the floor is yours. Let's talk a little bit about inflation. The headline number obviously impacted by gasoline a bit, but under the surface, things seem to be improving to match your expectations, frankly, my expectations as well. What was it about the number that you think gives the market a little bit of fuel here?
Well, I think it's that non-housing services were a bit softer. And, so that's things like, recreation services, the CPI looks at it differently, but financial services, medical care inflation wasn't as strong. But I think that's important. When you look at rental inflation, it did tick up a little bit, but generally speaking, we know that's on a better track going forward. And, a lot of the things that people had been talking about before, like motor vehicle insurance, as an example, that's going in the right direction, which that was a huge sort of issue over the last number of months up until recently. So the 3-month pace has basically ground to a halt in motor vehicle insurance CPI. Now, obviously, the PCE number looks at it a little bit differently, but I think non-housing services slowed, and that was a function largely of lodging away from home, so things like hotels, and less push from things like medical care inflation and auto insurance. And so basically, I think that's kind of what got the market going. And, considering the number came in better than expected, even though rental inflation ticked up a little bit, we know that the overall trend for that is still lower. So it just stands to reason that, if this number came in better than expected, despite rents going the other way, what's going to happen when rents kind of resume their downward trajectory, as I think is rightly anticipated. So I think that's kind of what the markets are keying off of. So it was a good number. And, this would be another month where, core inflation is running, somewhat below, on the PCE basis, below the Fed's target of 2%.
Now, do you think that's going to be sustainable given that employment report that we had this last time around? Or do you think this is going to be kind of this delicate dance between employment as we go, which seems to be firmer than expectations, and inflation, which is softening, but maybe put some type of floor on it?
So first of all, I don't think the last employment report was all that inflationary. And if you look at, wage growth as an example, I mean, it continued to, it remains benign. I mean, looks like if you look at non-supervisory workers, so the bottom 80%, I mean, wage growth among them has been below 4% over the last 12 months. And so, I mean, I think that basically sets the table for metrics like the employment cost index. And so I would sort of reject the idea that it was really that inflationary. I mean, if wages are running about 4% and productivity's too, you're basically right in the strike zone for the Fed's inflation target. So, yeah, I mean, I don't, and I must tell you, like, I don't, I mean, you take the data as it is. I mean, I'm not one of these people that like tries to do the unskewing of the jobs numbers. You know how you have like unskewing of polls, and you have certainly plenty of analysts that like to unskew the jobs number, birth, death, and the survey week, and all this sort of. I mean, you sort of take the number as it comes to you. But I must say that the anecdotes don't exactly line up with a sort of booming labor market. Now, maybe the anecdotes are wrong, but Meta is talking about hiring freezes, and they're talking about getting rid of some of their workforce. You have Microsoft, sort of similar. You have Brown Foreman. Everyone's doing dry January, I guess. Now they're starting to lay people off. So you kind of go down the list here. Citigroup is not doing their 401k match for a certain segment of their employee base, right? So these are not exactly the headlines that you see in a tight labor market. These are the sort of things you see in a loosening labor market. And my sense is that the fact that quits are low. So even though we got that strong jobs number last week, I mean, we did see the quits rate hit a cycle low also. That to me sets the table for wage growth at least through the first half of this year. So if wages are slowing down, I think that'll continue to take pressure off of inflation.
So, some of the things in terms of the back end of the curve, I don't think the front end is nearly as maybe a head scratcher as the back end. Obviously, there's a term premium that's being built into the back end of the curve, and that ends up being a bit of a sentiment indication. But how do you see the back end now? I mean, that's going to be pretty important as we go forward, because if inflation continues to come in, and most of this was, I mean, there's a pretty fat real yield available in the back end of the curve right now. So do you expect that term premium to moderate as we go forward and push rates down, or are you more in the camp that we're going to keep things more status quo in terms of those premiums? And a lot of that premium is around the unknowns, obviously the new administration and the like. But how do you come down on that?
Well, I mean, that's a good segue into, I mean, we do hear a lot that, well, the Fed went 50 and interest rates went up, and that's obviously a mistake. You don't want to see rates going up after you go 50. I mean, you don't want to see longer term rates going down after you cut either, right? So there's a bit of nuance to that argument. I mean, I think some of the increase in interest rates is welcome to the extent that it reflects like growth stabilization, growth optimism. I mean, if you have a soft landing, typically after the Fed cuts, you do see longer term interest rates rise. But sometime around maybe late October, November, things kind of changed, and term premium dynamics have taken over. I mean, and when I talk about term premium, you're talking about things that are unrelated to growth and inflation that's pushing yields up. I mean, it's hard to talk about just growth optimism when interest rates are exploding in the UK and Europe. I mean, who's optimistic about growth in those places? I mean, that's
Right.
not why interest rates are going up. So this is, I mean, you can ascribe it to Trump. I mean, certainly people are doing that. But, I think I saw Mark Zandi. Everyone wants to talk about how Zandi used to advise McCain to kind of give him this sort of bipartisan credentials. But we all know that he's someone that, sits on the left side of the bank, so to speak. And I mean, he had a nice, interesting tweet about, basically talking about threats of deportations and tariffs, and that's why term premiums are going up and interest rates are going up. And I just thought to myself, and we tweeted this out. No doubt that the threat of deportations and tariffs are why interest rates are rising in Japan, or in the UK, or in Germany. So there's a global element to this, and maybe that has to do with fiscal policy. Maybe that has to do with sort of the demand for sovereign debt versus the supply of sovereign debt. I mean, these are all considerations that go into term premium effects, but I wouldn't say that it's really just only a Trump story.
Mm,
I think there's a little bit more to it than that. I mean, if you have more certainty around the fiscal outlook, certainly that will help. So I don't want to dismiss the idea entirely, but I would argue that that's not really the overriding driver at the moment.
yeah. Well, speaking of, we've got some confirmations happening, Steve Pavlik. Any surprises so far, and anything that you're hearing on the docket coming up?
I wouldn't really say they're surprises. And unfortunately, just how the game is played. The other side tries to score political points by making an incoming administration's nominees look bad. I think so far most of the Trump nominees have performed probably as well as his team could have expected. So I don't anticipate anybody not making it through that we've seen so far. That said, I think it's probably telling that some of the maybe more controversial nominees that might not necessarily make it through. By that, I'm referring to RFK for HHS, Tulsi Gabbard for ODNI, Office Director National Intelligence, HHS Health and Human Services Secretary, as well as Kash Patel to lead the Federal Bureau of Investigation. I don't believe, as of this recording, their confirmation hearings have been scheduled. So my guess is we're going to see a lot more confirmation hearings next week. I think bunching them, again, from a strategic standpoint, makes sense. Make it harder for your political opponents by sort of forcing them to deal with all these people at once. Harder for them to spread their fire, so to speak. So that's sort of the takeaway. The one thing I am watching for ahead of Thursday, I think, hopefully if you listen to this Thursday morning before the hearing, is Treasury nominee Scott Bessent. I noticed that he, as well as I believe Kevin Hassett and Steve Marion, reportedly, and again, reportedly, we'll see if that's true, are proposing a tariff increase, more of an incremental approach, or 2 to 5%, with the idea that you'd raise them monthly. My guess is he's going to be asked about tariffs. He's going to be asked about whether that report is accurate or not. And I think that's sort of important because we talk about a lot of the uncertainty, and obviously there's really revolves heavily around tariffs. And I've heard sort of pros and cons for what was sort of laid out. If you're sort of smaller incremental approach, that might be better than some of the larger tariff levels that Trump was campaigning on. That said, if you're going to keep doing these incremental increases, is that going to force the other side, whoever's sort of, I guess, going to be on the receiving end of these tariffs, force them to think about how they're going to retaliate, as opposed to, if you just do one sort of bigger tariff, is there going to be one retaliation? So I'm not sure, but I think that's sort of looking for maybe some insight there, as well as to a lot of domestic issues. I think he's going to get asked, he being Scott Bessent, about a lot of the debt management, the debt issuance, and also the debt limit. In addition to, sort of what the tax cut package that Republican lawmakers are trying to pursue, some of the economic consequences and what that might mean to growth. So I would encourage people to listen to that.
So,
Elizabeth Warren will be nicer to him than she was to Pete Hegseth.
Well, that may be a pretty low bar, but I don't know. I mean, Elizabeth Warren, it's interesting for a lot of reasons, but watching how Democrats would respond in reaction to the recent election. There's some thought that maybe some Democrats would be more interested in working with the incoming Trump administration, less adversarial approach, less resistance last time. But if you look at some of the ones more on the left wing, that's clearly not, it doesn't seem, based on their hearing performance so far, any indication that they're looking at going more moderating their position. So
no, they're trying to go viral on Blue Sky Social. That's
So as we sit down here, there's talk about a ceasefire in the Middle East and potential release of the hostages. If we move forward with this, let's hope that works out. Does Biden get the credit for this? I mean, it is happening officially under his watch, but is this coming up to the kind of final hour of hell hath no fury, like a Trump that gets in without his hostages released? Who's going to get the credit for this?
Well, I think Biden will. The question, I think, only time will tell, is the duration of the ceasefire. I think that'll be a question whether or not it's a success. To have a ceasefire for just a few days or a few weeks won't be judged well in hindsight. So I think that's the first thing. But hopefully, for everybody's sake, this does last. And I think there's credit on both sides. I just saw the statement Biden put out crediting Trump. we know that Trump has a unique way of speaking and threatening, hell hath no fury. If you don't get this deal done, you're going to regret this come inauguration
I
day.
think
My
all
guess,
hell will break loose.
there you go. All hell will break
All hell
loose.
will break
All
loose.
hell will break loose if this isn't done by the time I'm inaugurated on Monday. I think that message probably resonated more than people might want to give him credit for in Iran. So
Yeah, I mean, when the guys dropped missiles on your lap before, or your general's laps before, I think maybe you take them seriously, right? But well, hopefully it was, I mean, I know there's a lot of legwork done, on the current administration. So to the extent that they deserve some of that credit, certainly I hope they receive it as a parting shot. Speaking of parting, anything on the way out? Any more surprises that we should expect? Now, we haven't seen pardons for the brother yet, right? I mean, is there anything else along these lines that we need to be just maybe preparing ourselves for as an exit gift, if you will?
I would put an emphasis on the word yet. I think there will be some additional pardons probably up to January 20th. So it would surprise me if President Biden does include his brother Jim in that. We've seen a number of executive orders here on the way out just to make it more difficult for the incoming Trump administration. We also saw the SEC launch an investigation into Elon Musk. My guess is the Trump administration won't follow through with that, or maybe they just lower the fine to $1. My guess is Musk and his relationship with Trump will probably prevail there, but there's still an opportunity just to try to hamstring the incoming administration. So I would keep an eye out for that.
Well, certainly these inflation numbers from our seat are important because we've really started the year with yields in an overbought state, and frankly, yields are probably 25, maybe even 50 basis points higher than our expectations around that. With the data that we were seeing and the trajectory of some of our indications around the market. In our sensitivity work, we know that essentially financial services do well in rising yields. It tends to be banks, it tends to be insurance, consumer finance, and the like. And it also tends to be energy. Energy had not been working up until very, very recently, so we'll keep an eye on that. But on the flip side, things that don't tend to work, utilities, REITs, kind of the cast of characters that you'd expect have not been working. So what I would caution on, just given this overbought condition without the clear trend of yields, higher yields being set, is that you get that reversion trade, that the REITs start to kick in, that some of these things that have been hurt by these higher rates actually end up with that reversion trade into February. That would be kind of the curveball here. Again, keep in mind that we're starting 2025 with beta as a factor that is overbought. It's still running in the high 80s. That's after being in the 99th percentile at the beginning of December, which means the beta run, if you will, has been stretched and likely to consolidate. On the flip side, and the good news around that is that value is just the opposite. Value is oversold. Cheap names have not performed well versus their expensive counterparts, and historically, again, unsustainable when we look at that through a rolling quarterly lens. So I expect that we're probably going to get some better performance out of value here in the first quarter, a little worse performance out of beta in the first quarter as we kind of level set and reset some of the sentiment that was out there. But all within the context, what I think is most important from a macro perspective is this overbought condition, both in the dollar, frankly, and in yield. So look for that reversion to have an impact on these various sectors and some of these industry groups as well. So we'll be watching that. Neil, what's on the docket next week for you?
Well, since we're recording this on a Wednesday, we will have retail sales and industrial production coming out later this week. The earnings on the holiday shopping has been a bit mixed. We saw Macy's a bit softer. I think Abercrombie was a bit softer, but on the other hand, there were some other retailers that were pretty good in terms of what they were reporting. So we'll see what the census says about it all. We'll also get data on industrial production, as I mentioned. And, look, we didn't get a pop in manufacturing manufacturing employment with the last jobs number. I mean, that was one of the key features, frankly, in the employment data was the ongoing slowing in goods producing employment. So the fact that manufacturing declined, I don't think that says anything good about manufacturing production. So those will be the main, two data points. And then, the week after, it's going to be, relatively light. We will get the early reads on manufacturing and services PMIs from S&P Global.
And Steve, next week, what do we have? Obviously, Monday,
inauguration day, and I think there's always sort of a lot of attention to quote unquote the executive orders from day one. My sense is that Trump is going to follow through a lot on what he campaigned on and focus a lot of these initial executive orders on energy, really expanding domestic production, specifically fossil fuel production, to try to meet uh, demand that's expected to grow if we're going to realize some of the potential here with artificial intelligence and crypto. So expanding energy output is really important goal for the Trump administration. I also think he's going to go to another priority, which has been immigration, really reversing or just going back to, I guess, reversing the Biden administration policies that Trump had in place originally. I think that's sort of the initial focus. From there, I get a lot of questions about mass deportation. I'm not sure how mass it's going to be, but I guess it's going to be focused on those with the criminal background. I think they'll sort of maybe reevaluate where they are after that point. And then the thing that I'm watching for, I mentioned sort of this tariff proposal. Is that going to be into this quote unquote day one? When I mentioned day one, I'm really thinking about the first week because there's been talk that Trump may try to invoke the powers through the International Economic Emergency Powers Act to impose tariffs. Now, that's never been done before. Doesn't mean it can't be done, but that was one of the things being discussed. Because if you could do that, that would obviously be a beginning of the year event, as opposed to usually the Section 232 or 301 investigations, which require Commerce and USTR to get involved, and that'd be more of a mid-year event. So I think that's the thing I'd keep an eye on. And then any additional confirmation hearings. I mentioned some of those folks that may have a more difficult time being confirmed, whether or not they get hearings next week. If they do, that'd be something to watch.
well, we're going to continue to watch what we think is this reversion trade. So we'll look for more evidence of that. And then just the sustainability, right? When you're in a consolidation, we had the percentage of issues above the 20-day moving average get to an oversold condition. We started the year out there, which was good news. We did have some positive divergences develop here in the last week. The number of 20-day lows was contracting. The number of names above the 20-day moving average was actually expanding as we were going on to make new lows. Those are good signs that kind of the ferocity of the move to the downside is being halted. So we want to see that. We saw it, and then we want to see that response, which is clearly what we're getting here. So we'll continue to watch that. And then really the question is, if you're in that consolidation, kind of coming out of that consolidation, which has really been tumultuous with the beta plays and not that atypical around the end of the year. But what you're really looking for is who are the relative strength leaders on the way out, because that becomes important, helping to set the tone and frankly help set the narrative for what's going to drive performance in 2025. Some of those early indications, we've had good responses out of banks here. Financials still look to be very, very strong. They're still relatively cheap, believe it or not, versus many other things in the market, and still have some of the best trends. So that'll be important as we go. And then obviously we continue to watch these credit spreads because credit has been such an important driver of this market. A deterioration in corporate credits, particularly vis-a-vis treasuries, would be an indication that things are getting long in the tooth, and potentially the Fed is making a more restrictive policy mistake. Not seeing that, but certainly those are the things that we'll be watching. Well, join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter, subscribe to our YouTube channel. And until then, you can say hi to our executive producer, Harry Chen. Thank you, Harry, for joining us. Until next week, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.